I thought the labor market was strong. What happened?
Data revisions. You look at the last 3 months of non-farm payrolls report, it now shows 98,300 jobs were lost in the economy if you exclude the healthcare sector.
We've talked about how GDP would slow as the US economy pays the cost of tariffs. That slowdown is here.
Actual tariff revenues collected by the US Treasury suggest that the US economy has only paid half the overall cost of the tariffs. That to us means this economic slowdown is likely to persist.
Hello and welcome to the Outlook by STRAT. Mike, we have economic growth slowing. You've got tariff rhetoric in action picking back up. And the most recent jobs report got the head of the Bureau of Labor Statistics fired. So it continues to be very interesting times in markets. Let's dive into our outlook for the remainder of the year here. Starting with economic growth, looking at real domestic final sales, GDP, ex net exports and inventories. And you can see a pretty clear slowing trend here.
We've talked about for a while now how our outlook was for slowing economic growth because the 3 get-out-of-jail-free cards for the U.S. economy as it pertains to the impact of tariffs weren't going to apply this time around, and the U.S. economy would ultimately have to pay the price. And all of a sudden, the data very clearly shows that that is happening. You can see the sharp slowdown in the Q2 data. Consumption is the most concerning component. And we'll talk about also the slowdown we've seen in hiring and the impact on the Fed as well.
Yeah. And so kind of a first level or gut reaction to some of this information is, well, the tariffs have taken effect, and this is a one-time price increase, and we'll get through it.
Right.
But that's not quite the case here, is it?
Right. So 2 things going on here. One, if you look at this dark blue line, that is the effective tariff rate on U.S. imports as announced by the Trump administration. So that blue line has ticked up here in the last week or so as that August 1st deadline expired. Trump administration reached trade deals, and it looks like the new baseline tariff rate is 15%. So first off, tariffs are going in the wrong direction. They're moving higher. They could move even higher as sectoral tariff announcements on semiconductor chips and pharma come out in the next week or so, quote unquote.
Yep.
And then also you have China. The truce there ends on August 12th. So does that get extended, et cetera? Either way, dark blue line moving in the wrong direction. But the reason why we think this growth slowdown still has room to run is because it's happened even though the U.S. economy to this point has only really paid half of the stated tariff rate. And the way we look at that, if you look at the actual tariff revenue collected by the U.S. Treasury, it would equate to about an 8% effective tariff rate. So there's clearly been a gap, a lag between the tariffs that have actually been collected versus the policies announced. And we know some of the reasons for that. There was so much front running that went on. Companies got ahead of this. They haven't had to restock at these higher rates. 2, anything that was already shipped or on the water was exempted. So that was a lot of the front running activity was exempt. And then it takes a while, at least a month for goods to get here. And then finally, there are payment grace periods of up to a month and a half if you're paying your tariffs online. So all that equates to, companies haven't had to pay full freight yet. The economy has only paid about half the total cost, meaning they still has to pay the other half, which we think will happen at least through the end of the year. So that's why we think this slowdown can be a little sticky.
Yeah, potential for a double whammy here. The expectation for the green line to move closer to the blue line, and the potential for this blue line to go further up,
right,
as more tariffs get announced. And what we've talked about in some past videos are the economy has to pay for these tariffs in some way, whether that be foreign exporters, companies within the U.S., or consumers. And what remains to be seen is how that is going to get divvied up. And looking at the inflation data, starting to see some differences between goods and services inflation.
Yeah, on the goods side, you are starting to see companies pass on costs to consumers. Once again, they haven't had to pass it all on, and some of them are taking a wait-and-see approach until a lot of these trade deals were done on August 1st before they do that. But that's the good side of the equation. The U.S. is a service-based economy, and if you're someone like the Federal Reserve, for example, you're looking at any increases in prices on the good side and saying, that's a one-time price adjustment. It's going to fall out of the year-over-year numbers 1 year from now. That's sort of noise. I'm worried about the signal. If I need to cut rates right now, what is the signal? The US being a services-based economy, the Fed thinks, we think, super core inflation is a better measure of that, what really drives the bus here. Super core is core services X housing. And on a 3-month basis, that has been running below the Fed's 2% target for 2 consecutive months now, the lowest since 2020. That, to us, if we're the Fed chair, is a green light to cut rates. You have the go-ahead, if you need to cut rates without worrying about this tariff inflation mess sort of pushing inflation away from you. The service side of the economy is signaling or echoing the slowdown in economic growth we've seen and saying, perhaps we need rate cuts.
Yeah. So inflation side saying you can cut if you need to. Labor market side maybe being a little bit more strong than that, right? Saying perhaps it is time to cut, or you should have already cut. Looking at the 3-month net change in jobs, ex healthcare lost about 100,000 jobs in the U.S. economy.
Yeah, and that didn't. the market and the economy really found out about that, about the last 3 months of data last Friday, because the revisions to the June and May jobs report were significant. In total, 258,000 or so jobs were revised out of those 2 months. Hence, the head of the Bureau of Labor Statistics getting fired. And so now you put it all together and it's, oh my gosh, maybe the Fed should have already cut. Maybe they should have cut earlier in the spring had they seen this coming.
Right.
So this is definitely concerning for a couple of reasons. One, obviously, if you look outside of the healthcare sector, the economy's shedding jobs.
Right.
Okay, so that's screaming rate cuts.
Yep.
On the other side, you could play devil's advocate here and say, well, the unemployment rate is only at 4.2 or 4.25%. The Fed last summer said 4.4 was the line in the sand. They didn't want it to go above that. So this isn't too concerning from that perspective. But if the U.S. economy is shedding jobs or only adding 30, 40,000 jobs per month, that is well below the break-even level required to keep the unemployment rate stable. Meaning you don't have long before we're at 4.4% unemployment. So you got to do something. And the Fed doesn't meet again until September.
Yep.
So we think if the Fed had this labor data when they met in their July meeting, 2 days before it was released, they would have cut rates.
Yeah. Not to mention, getting specifically into Fed outlook a little bit more, you've got the okay from the inflation, you've got encouragement from the labor market to cut, you've got 2 dissenters at the July meeting wanting to cut, and you have the opportunity for President Trump to appoint another member of the Board of Governors who presumably will want to cut.
Yes.
So it seems like cuts are coming.
Yes. Our outlook has been 4 to 6 rate cuts seem justified between now and the end of 2026. That was pretty out of consensus. Now the market has moved right towards that. It's a little over 5 cuts are the market's expectation between now and the end of 2026. And we think they should have already started. And it doesn't ultimately matter if they get delivered by Jerome Powell because of weakness in the labor market, or they get delivered by Jerome Powell's successor due to political pressure. 4 to 6 cuts seems very reasonable. That's why we think the market is hanging in there right now, given this big data shock that we just got.
Yeah. And history doesn't repeat itself, but it certainly does rhyme. Just last August, we were talking about some similar themes, right? Labor market slowdown, what could be coming next. And we talked last year about how that was likely to be a blip.
Yeah.
And markets would recover in time. A little bit different this time around.
Absolutely. I mean, if you go back to the second slide we shared, all of this has happened even though the U.S. economy has only paid half the price of the tariff. So if the other half has to get paid, this slowdown could be much stickier. Also, a lot of the weakness in payrolls last summer got revised out. And, the SOM rule untriggered and the unemployment rate fell. This would be a lot to get revised out.
Yeah.
This revision we had to the May and June reports in total was the largest revision outside of a recession since the 60s. To get all of that revised out, it would speak to maybe some shady dealings going on.
The new head of the Bureau of Labor Statistics has their work cut out for them.
That would be tough. when you have a growth scare and you think it could get revised out, what recovers first? Equities recover almost immediately. Bond yields rise from there, but later with a lag.
Right.
We don't think that's the playbook this time around. We think there's more to come here. Staying defensive seems warranted.
Yeah. And in expanding a little bit further on, potential market opportunities, right? Perhaps not surprisingly, a theme of ours is global diversification, right?
Absolutely, yeah.
Managing exposure to the U.S. economy in particular.
Mm-hmm. Yeah. And so you think about these policies that are being enacted, the aim or the ultimate goal of the Trump administration through these tariffs is to reduce the U.S.'s current account deficit. Current account deficit is akin to our trade deficit, right? The other side of that coin is, if you reduce the amount of stuff we're buying from the rest of the world, you're giving the rest of the world fewer US dollars. And if the rest of the world has fewer US dollars, they have fewer US dollars to invest in US dollar denominated assets, US stocks, US bonds, etc. So if you reduce the current account or the trade deficit, you also reduce net foreign investment, which means perhaps the US economy, the US stock market isn't the only game in town going forward. The US dollar is not the only game in town going forward. Global diversification, looking at the global opportunity set, we think makes sense here as you look at the aim of these policies and what they're actually going to end up doing, and how you think about portfolios.
Absolutely. Yep. Well, that will do it for this edition of The Outlook. If you have any questions or comments, please feel free to reach out.